I think we're going to have another bout of disinflation and perhaps even head into a truncated period of deflation as just everything just shuts down in the economy. That's a very salient risk.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 6th through May 13th, 2024, while supplies last. First, we feature 2023 1-ounce Silver Krugerrand at $3.10 over spot. We also have 1 10th-ounce gold Canadian maples at $29 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this returning guest. Michael Pento, the founder of Pento Portfolio Strategies, is an active money manager. He's been keeping us abreast of what are the leading indicators that tell us what's coming next in the macroeconomy and the financial edifice that affects all of our lives. Michael, thank you for coming back on Liberty and Finance.
It was a pleasure, Dunnigan.
You send out a weekly update that to all of your subscribers that I've been blessed to have access to, and I call it the midweek sanity check. I think you call it the midweek reality check, and very grateful for that. And we'll ask later in the broadcast how people can avail themselves of that. But right now, we wanted to follow up with your latest observations and what you see ahead, because there's been rising concern about the health or ill health of the U.S. dollar for one thing, but specifically with eyes on the Japanese yen and other indicators that have been supporting perhaps the U.S. Treasury bond auctions and so on recently, that are now looking like they're a bit shaky from the Japanese central bank being able to defend their currency. And they've been following a playbook. They're probably, if you want to call it ahead, they're about a decade at least ahead of most of the Western countries in the playbook that they've been following. And yet it's not working out too well for them in many regards. Can you bring us up to date on what you're watching and what it's indicating to you about what's likely lies ahead?
It's funny you asked me that question. And I have no idea, by the way, what the questions you're going to ask me. I mean, I'm honestly, right? You don't, yeah, but this morning I was just actually doing some research on Japan, because I happen to think that Japan is dumping gold and dollars to prop up their currency. They're dumping treasuries, which are dollar denominated, dumping those, buying the yen on the FX exchange. I think they're dumping gold too. And for days like today, where I saw the yen was very weak overnight. And then you say, well, why is gold down today? Interest rates are down and the dollar's down. Shouldn't gold be up? But I think the bank, that's my theory. I can't prove it. But, people say, what's the big deal if we become Japan? Japan's, nice place, nice island nation. But when you think about it, Japan's a train wreck. The Bank of Japan is the market for JGBs, Japanese government bonds. Without that, there is no market. They don't trade. And if you look at the Japanese GDP in dollar terms, it is flat going back decades. So not years or not quarters, not months, not years, decades. That particular nation, that island nation, with no natural resources and a currency that's hanging by a thread, their GDP has not increased at all in dollar terms. And then if you look at their stock market, it peaked 35 years ago, and it's still lower in nominal terms than it was 35 years ago. Lower in nominal terms today. So Japan is a disaster nation. It's a zombie nation. And if that's our aspiration, and I think you pointed out that they're ahead of the United States by about a decade, it's very possible that's where we're headed. Where the bond market doesn't function because the Fed just takes over our bond market. No one who wants to buy a treasury at the artificially low yields, right? Because every auction is being satisfied by the Federal Reserve. That's what I think where we could be headed, and that just marks stagflation. The yen, I think the yen is down 15% this year against the dollar. And when you import if you're importing all of your goods, and your yen is down 15% against the dollar, a major trading partner, it's down against the euro and it's down against even the yuan. Those are the three major trading partners of Japan. It's a disaster. So I think we should aspire. I think Americans should aspire to have a greater outcome than Japan.
This phenomenon of Japan's currency being down the drain, what about their attempts to being ahead of us at yield curve control, defending their interest rate, et cetera, and how that's playing out for them?
But I just mentioned is that our future then, where inflation is so high and the debt levels are so high? I mean, Japan is the highest debtor nation of any developed world as a percentage of GDP. There's like well over a quadrillion yen in debt outstanding. It's an insolvent nation, and the only buyer is the Japanese central bank, the BOJ, and that's where I think we're headed. So it will be a perpetual condition of stagflation and no growth, a zombified economy, and very high inflation.
In that kind of an environment, if that paints a picture of where they have brought themselves and where we may be headed, what kind of positions as an active money manager do you look to protect your clients and preserve their purchasing power in a stagflationary environment?
Well, I don't remember the exact figure, but I think it was, I want to say 35% is what gold is up in yen terms this year, 35 or 40%. And gold is surging as it's priced in yen. So yes, the answer is stagflation when you have no growth and stubbornly high inflation. The answer is buy gold. That would be the first and foremost thing that I would buy. Base metals and energy in the secondary and tertiary positions. How
does the Japanese struggle with not being able to find any external buyers of their debt portend the U.S.? It seems like we're in an environment where it's not just for financial interest rate, yield reasons or other reasons like that, but there seem to be multiple reasons why the U.S. may be struggling going forward with finding foreign buyers, in particular for the U.S. Treasuries. You've touched on Japan's plight, but what about the U.S.'s plight? And are there specific other drivers that may be affecting the U.S.'s difficulty in selling Treasury bonds going forward?
Well, other than the fact that the U.S. is insolvent too, you look at a quarter of all our revenue now is being spent on interest payments. So it's an insolvent nation, but you have that in common with the Japanese condition. But you also have something that Japanese don't have. Is even worse, is that we have the world's reserve currency, and we're abusing that status on a regular basis. And one of the things that we're doing to abuse that status is this unilateral hegemony use, where we just say we're confiscating your reserves. And so if you're a nation that has a very high trade surplus, and you recycle that into a capital account surplus. So in other words, you're buying treasuries or you're buying properties, you're buying things that are dollar denominated with your excess savings, your currency reserves. And then capriciously and arbitrarily, the United States says, those reserves aren't yours anymore. They're ours. Well, that scares nations. We've done that before. I'm not saying we're wrong to do it. I'm saying that's what we do. So, and in some cases it might be justified. But here we're talking about finance here, right? We're not talking about morality. We're talking about finances here. So what nations are doing is they are saying, rather than parking my excess, my trade surplus, my excess reserves with you in treasuries or purchasing capital in your nation, what I'll do is I'll just buy gold or I'll buy Bitcoin. And I control it. It's in my purview. And that's how they're getting around any future sanctions or confiscations that could come up in the future. And we just hear, both presidents, right or wrong, this is what they're saying. There are massive trade wars with China brewing here. Tariffs, and that's just one of the reasons. And tariffs aren't confiscating reserves, but they're not the same, but they're cousins. And that's why I think China, Brazil, Venezuela, Russia, just to name a few nations who are just starting to eschew dollars and running to gold.
Yeah, you just touched on the collaboration, the BRICS as it's called, or BRICS Plus, of nations of the world that are turning away from the dollar, not only as a trade settlement currency, but perhaps as a reserve and a storage of their liquidity, that sort of thing. Do you have any other current observations about this global, pivot, or this global gathering of minds and hearts that seem to be striking out on their own and perhaps relying on commodities or other real things rather than on debt instruments for their financial savings?
No, listen, you have to have faith in a currency's purchasing power in order to place your reserves in it. And if you're losing that, you have to find other sources. And if you're losing that faith in its purchasing power and it can be taken away from you in nominal terms, capriciously, you have to find another alternative. And that's hard assets.
What's your, how do you boil that down for individuals for whom you are managing money as an active money manager? How do you position them for the environment that you foresee with the stagflationary environment? And are some of your moves mirroring things that these foreign countries are doing as far as looking at real things like commodities, et cetera?
I don't get ahead of the market. I don't tell the market what to do. So I believe since we have a huge problem now, let's just back up a second and allow me to elaborate for a second. So we were headed in this condition anyway, insolvency. And we were headed in that direction before COVID, but COVID exacerbated and expedited that condition. And now you see like 40% of the Russell 2000 is unprofitable. Corporate debt is $13.7 trillion. That's up 100% since 2007. Corporate defaults are soaring. They're up 80% since 2023. There's $1.3 trillion in credit card debt. Now, I want to just point out two other markets to you. So CLOs, collateralized loan obligations. So those are loans to businesses who really can't get money from a bank. That was $300 billion in 2008. It's $1.4 trillion today. That's a 366% increase. Then you have something called private credit. That's loans to businesses who can't get a loan from a bank or issue corporate debt. That was basically it wasn't even a market prior to the global financial crisis. It was $100 billion outstanding in private credit. Now it's up 1,600% to $1.7 trillion. And that's those two things. So you have three things: corporate debt, CLOs, and private credit are multiple trillions of dollars that are recycling that debt at higher and higher rates. They locked it in for a while, but now as every day passes, they're having to issue this debt at higher and higher rates. So I ask you to give me a little leeway here, so I'm going to tie it all together. So I believe that the Fed has to cut rates dramatically in the next quarter or two, significantly, trenchantly, to avoid the next recession. The problem is they can't do it. And the reason why they can't do it, they can tinker around the edges. They can lower rates by, 25, 50 basis points. But here's the issue. Here's the reason why they can't. Home prices are up 50% in the last 4 years. 50%. Taxes and insurance costs have skyrocketed. Dylan, home ownership is unaffordable. And then you take food prices, they're up 37% according to the Wall Street Journal, 37% in the last couple of years. So when you have a consumer and corporations that are under this much debt and this much an onerous condition of refinancing the debt, what really needs to happen is for prices to fall. But what's happening is they're going up at a slower rate. So again, let me reiterate. If home prices are up 50%, and they are, according to Case-Shiller, in the last 4 years, and I pulled that data up this morning, so it's fresh data. 50%, 47 change to be exact. Home prices need to fall, not go up more slowly. And when you're when your trip to the grocery store costs almost 40% more than it did a few years ago, prices need to fall, not go up more slowly. But the Fed is out there saying, you know what, we have a victory. So they're not going up 9% anymore. They're going up 3.5% year over year change. That to the Fed is a victory. And why is the Fed interested in declaring that, obfuscating that as a victory? Because they understand if they don't get interest rates down quickly, we're going to have a recession, and it's going to be a sharp one. I don't think they can until the credit markets freeze and the money markets freeze. And in that case, we're going to have, and here's where I'll wrap it all up, I think we're going to have another bout of disinflation and perhaps even head into a truncated period of deflation as just everything just shuts down in the economy. That's a very salient risk. So how am I positioning my clients? I'm getting ready for possibly moving that in that direction, which would be sectors 2 and 1 of my investment spectrum. And then I see intractable stagflation after that, because the Fed's going to say, listen, we have to ignore the fact that home prices are up 50%. We can't let them drop even maybe 15, 20% without bankrupting every bank on the planet and every pension plan. And the consumer would, the wealth effect would go into reverse in a huge way if stock prices drop by 40%, which is where they need to drop just to bring them back into historical norms. So they can't let that happen. So then we're going to just go back to ZIRP and QE and helicopter money. And if that happens, you're going to see intractable stagflation like we've never before seen. So a lot depends on what the government does. I think, and I even heard Janet Yellen today say that, listen, we have to get rates down. The Treasury cannot afford to refinance its debt. Don't forget the 10-year note was 33 basis points right after COVID. Now it's 4.6%. The two-year note's almost 5. It was 4.85%, 4.9. It was 5% a few days ago. But they just can, and they're issuing a lot of T-bills, right? A lot of this debt is being issued at the short end. Now, paying next to zero is great, but paying 5% when your debt to GDP is 123%, you have, was it $38 trillion of debt outstanding and rising rapidly? When your annual deficits are $2 trillion, when the interest on the debt is $1 trillion, it's just not a tenable position. So what I'm saying is the government understands that to keep the ruse alive, it's a lot easier just to pursue inflation than to lie about it. They do. They use mendacity. And why wouldn't, any sentient central banker would say, listen, home prices are too high. They're not affordable. There's no market for them anymore. They have to come back down. But they don't care about that. They care about banks. So they're going to flood the system with liquidity. And I see a very, very long and dangerous and unsuccessful battle with stagflation coming forward.
You went right where I was hoping you were going to go with this, and that is the lies that we are being told about what the real goal is. We're being told, the real goal is full employment, and the real goal is low inflation, and the real goal is stable currency and all this. But in fact, it seems that there are potentially one or even two major goals that are never being discussed. The first would be intentionally inflating the currency away so much that it basically you don't have to pay off the debt, which you can't pay off because you've simply made it worthless through inflation. The second would be actually trying to destroy the currency or all of those financial edifices around it in order to reset the system and introduce a new system, which would bring a lot more control and loss of privacy and that sort of thing. So you can take either of those any way you want, but what about that first one about that the Fed is not being straightforward with us about what their true goals are, that they're just talking a good talk, but while they're walking in a completely different direction that's against the interests of the people?
Well, if the Federal Reserve came up and said, our goal is to be the banker's bank, and we care about keeping bank liquidity functioning smoothly, that's really our primary goal. And then By doing that, they have a tool. It's a fiat currency. It's not backed by anything. It's unfettered with the price of gold or tied to it in any way or any commodity. It's not tied to GDP growth. It's not tied to productivity growth. It's not tied to population or labor force growth. It's tied to one thing. What do these 12 apostles, the 12 voting members of the Federal Open Market Committee, what do they think? That's what it's tied to. And so what they say is their calculation is, well, banks will go under and we'll have a depression if we let asset prices fall to where they should be, where they can be supported by the free market. Can't have that. So we're going to pretend that we care about the poorest among you. But if they did, then wouldn't they just look at the Wall Street? This is not my numbers, the Wall Street Journal, and they undercounted it, a 37% increase in food prices. Nobody's income. Nobody. A very, very small percentage of the U.S. population has had their incomes increase 37% over the past few years. And as a matter of fact, if you look at the BLS data from the non-farm payroll report, a lot of people are losing we're creating part-time jobs and losing full-time jobs with benefits and higher wages. So there's a cogent argument to be made that, your incomes are flat. They're skewed to the wages and incomes are skewed to the higher end. The top quintile is doing fine. The lower four are getting wiped out. 78% of Americans are living paycheck to paycheck. I think some 60% of them don't have $1,000 in the bank. And that's a success. This never would be remotely possible if we didn't have 100% fiat currency. And the Fed didn't think they had a tool. I said, wait a second. Why do we have to live in reality? We could just print money. And every recession and every bear market can be monetized away with our tool. Isn't that wonderful? That's the truth. Then again, that's why I come on shows like yours, because you get the truth. The truth is that when you were able to untie your dollar, or whatever nation, Zimbabwe, Argentina, Hungary, Germany, whatever nation pursued that path, and they've done, various times throughout history, of just saying, hey, let's just print money to keep interest rates from rising and buy our debt. And that always gets out of control, and that always leads to hyperinflation. So you say, well, and some people say, well, that, Mr. Pento, that could never happen in the United States. Why not? Do the laws of economics not apply to the United States of America? Oh, because we're the world's reserve currency, but we're losing that. But Rome had the world's reserve currency, the Roman Empire, and that caused that still didn't prevent inflation from going to 1,000% per annum in Rome. It can happen. If it happened in Rome, the only world power there was in the known world, it could happen to the United States. Absolutely. Remember this, that it wasn't too long ago when I first got into business, about 33 years ago, where the idea of having a deficit that was $1 trillion would be completely anathema. Central bankers were bragging about how we would never have $1 trillion in deficit. We would never monetize debt. Well, you've monetized $4.5 to $5 trillion just since COVID. Monetized, you just printed it. The central bank's balance sheet went from $700 billion in the wake of the financial crisis, prior to the financial crisis, to over $9 trillion. And now they're in a rush to stop quantitative tightening. Why? You happy? Are you happy with inflation rising at 3.5? Now, I did go to school and did take a lot of math classes. So is 3.5% higher than 2? It's a lot higher than 2, right? So why are we looking for reasons to cut interest rates? And why are we looking for a way to get out of quantitative tightening when inflation is way above your target? And like I said before, prices need to fall, not go up more slowly from an unaffordable level. That's the truth.
That's one of the most distressing things to me, is that we keep getting told untruths and we keep getting not told the truth by the mainstream financial press and most financial advisors, which most people are using, are not telling them these things. And I remember the quote from Henry Ford said, if people knew the true nature of our financial system, there'd be riots in the streets by the next morning. And I think, that may be another reason why we're not getting told the truth. Besides the fact that the other mantra about you'll own nothing and be happy, where the banks become and the central banks become the lenders and buyers of last resort, owning everything if you have a big enough financial crisis, seems to be the direction that things are going, with consolidation of real estate ownership, et cetera. And I did want to get more into real estate, but I think we're running out of time for this visit, so we're going to have to tackle that in a future visit. And I just want to make sure people have a chance to know how to get a hold of you, Michael, if they want to look into your services as an active money manager.
So my website is pentoport, PORT.com. And on that, you have the podcast Midweek Reality Check, which I put out every week. It's $50 a year if you want to own it. And if you want a 5-week free trial, you can avail yourself of it there. And if you have $100,000 and you're a U.S. citizen, I'll manage your money, personally where my money is in the stock market, which is in the inflation, deflation, and economic cycle portfolio. Yeah, Dunnigan, the government is creating a lot of crises, and they're going to be the ones that are going to tell you they can bail you out too. So maybe there'll be some, Fed coin launched here in the near future, where you have, and people who don't educate themselves by listening to shows like yours, like, oh, that's nice, a Fed coin, isn't that wonderful? Because I'm sure it'll be very helpful to me. But when you can't take your money out of the banking system, you can't hoard your cash, and you have no privacy, and you're completely subject to whatever whims that they want to impose on as far as interest rates are concerned. They can be negative, and there's nothing you can do about it except take your money and spend it. You cannot get out of the banking system. So that has implications for the supply of money, the cost of money, the velocity of money, and it's all bad.
And privacy and freedom,
unfortunately. Yeah. And I'm laughing because it's so sad. If you're just like a guy who's like, I have my 60-40 portfolio, and don't you know that the market always comes back? Well, wait a second. The market doesn't always come back. It's not always true. Sometimes it takes years and years for it to come back. And who approaching retirement can afford to lose 30, 40, 50% of their portfolio? And who's to say, well, this is not Japan in 1989, 35 years later, still waiting to get back to the all-time high. So, and what do you want to own? Do you want to own treasuries? And where do you want to own treasuries? You want to own short duration treasuries, or do you want to go way out on the yield curve? You want to own short duration treasuries when you have deflation and maybe some duration, but when you have intractable stagflation, you want to avoid treasuries completely, especially on the going out, zero coupon bonds and duration, because of convexity, those prices are going to plummet. So things like that. And what stocks do you want to own? Do you want to own base metals, energy, and precious metals, and high volatility stocks, or do you want to have low volatility stocks and bond proxies? That's what my investment model is all about.
Well, Michael, we're grateful for your presence here. I know we are on a tight timeline today, so we appreciate you fitting us into your schedule and bringing us this update. We'll look to get back with you again next month when we can, and get another look ahead with you on the direction that things are heading. It doesn't sound promising for the ordinary person. And the biggest takeaway I have from this chat today is that the Fed does not have your back. So you've got to get your own, you got to get the right kind of advice, and you got to make the right kind of moves, because the Fed is not watching out for the ordinary person. Michael Pento of Pento Portfolio Strategies, thank you once again for joining us on Liberty and Finance.
Thank you, as always, Donnie.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 6th through May 13th, 2024, while supplies last. First, we feature 2023 1-ounce Silver Krugerrand at $3.10 over spot. We also have 1 10th-ounce gold Canadian maples at $29 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.